Welcome to After Hours at Traders Post for February 28th, 2025. I'm Tom Hartman, joined as always by Mike Range Caller Christensen. After Hours is your go-to market commentary show powered by Traders Post, the best automated trading platform in the known universe. But more on that later. Tonight, we're tackling the biggest market stories of the week. Who could have seen this market downturn coming? All right, Cem Karsan. Luke Gromen brings monetary policy to the big leagues on Tucker Carlson's show, and Nvidia is showing signs of topping, or is it? The bell has rung, so let's dive in, because as traders, we don't just watch the news, we trade it. All right, Mike, how's it going?
Doing well. It's been an interesting pullback week. So if you've been short futures, you've done well. And every single morning this week, I've been too busy wrapped up in meetings to participate. And every single time I look at the chart afterwards and I go, I trade the open. That's my thing. And I missed three of the great openings this week, which really makes me frustrated. But interesting support from here. This is speaking of range calling in general. We've been in this interesting Trump range, as I'll call it, since Trump was elected, and we just pulled back right to the range where we were when he was first elected. So kind of giving back all the gains that we've experienced since he took office.
Oh, well, what I've been enjoying, and this is the reason why the first story today is the Cem Karsan story, is that actually, let me just pull it up over here. There's all kinds of reasons why people are saying that the market's down. So people are worried. Warren Buffett and a bunch of other billionaires were selling stock. And I love the summary from Grok here, that the stock market declined.
I find the Warren Buffett story really funny to me because he's been stockpiling cash for a really long time now. What is he up to now, though? Was there any indication of he sold more than 134 billion? So I think that puts him closer to 400 or 500 billion in cash now, right?
Right. Well, I'm not even because what I like is when somebody calls for the downturn or an upturn or whatever in the timing in the window. Then I go, okay, that's the person to listen to. If I'm just sitting around wondering what Warren Buffett has purchased, who knows when that trade actually pays off?
That's true. That's right.
So Grok here was just given a sentiment of this market decline. So the stock market has seen a significant decline since February 21st, 2025, largely due to disappointing economic data. False key reports such as consumer sentiment at 64.7, below the expected 67.8. Please tell me, Mike, did you wake up this week and go in, I wonder what the consumer sentiment is? I need to buy or sell accordingly? Home sales were down from, instead of the 4.13 forecasted, 4.08, blah, blah, blah. Bitcoin is going to fall, yada, yada, yada. All the sentiment around why the markets are down.
That's right.
And that's not the case. What I want is a nice little victory lap for my homeboy Karsan, mm-hmm. who explains quite clearly why we're at this market downturn. Remember, it's all about positioning and flows, money flows. So I'll just play this real quick, and then we'll talk about it on the other side.
Some trouble here. Equities are at the lows of the day. Nvidia started off strong, faded, went red. We're bleeding out. Cem Karsan is here with us to try and figure out why and what happens next. He's a senior managing partner at Kai Volatility Advisors. Great to see you, Cem.
Good to be here. Always fun.
So causality first, timing-wise, what do you pin this on the last week, going back to basically Thursday?
Well, I mean, understand that we've highlighted this exact window for months. And so people that sit out there and say, oh, it's Nvidia earnings, or it's nonsense, right? These are the flows, stupid, right? March is a big OPEX. We've talked about the Feb March window for years and how COVID, was defined by the day after Feb OPEX and the day after March OPEX. By the way,
so just a reminder for people, COVID, the drop in markets and Bitcoin and the regular markets was in this exact same window, right between February 20th and March 20th. This is what you're just saying, hey, I don't know what to tell you. We're exactly in that same window, and the exact same thing is happening again.
By the way, nobody talked about that. All of a sudden, you start hearing about it the last several weeks out of nowhere.
You've spoken about that timing before, which is that the Feb COVID sell-off. I mean, this is pretty much almost like the same week.
Correct. And we've talked about this for a couple of years, how important quarterly OPEXs are, and the tinder that comes from a quarterly OPEX can be to help generate a decline. The vol risk in a portfolio is tied to where the positioning is, and the positioning tends to be concentrated in these quarterly expirations, especially after a big ramp up, end of the year, all the excitement with the new election, all the vol coming off the table at the end of the year. January, February are the parts you want to be careful of right at the options expiration. Of course, Friday options expiration was the opening of the window.
So the window of weakness here. Option expiry happens. The protection to the downside has been removed temporarily, and if there's a catalyst that happens within that that zone and it's momentum towards the downside, well, all of a sudden people are chasing in order to protect their positions, and these sorts of things happens every quarter, especially for February, March, and then especially for September, October, which is why most market crashes happen in those areas, because December and June, August, people are on vacation. So I just want to actually just jump. You guys go take a look at this video. It's really good. All his stuff is really good. But I want to just jump to the end here where he talks about the recessionary risks that he's seeing coming up, because that's what I care most about. Okay, you told me what happened. Now what's the next call? And he outlines these two potential paths that we can take.
And so right now, supply side economics to the rescue, try and fix inflation. But in the long run, politically, it's going to be unpalatable for people. And if we go into a recession, which is what they're doing, they're going to push us into a recession to pull demand off the table and then respond with QE.
Okay.
That's the recipe.
You think this is happening this year?
So this is happening this year.
Okay. All right. So take me through the steps then. We got kind of the political-driven, your logic for how they try and navigate this. Back to kind of the vol and the timing and stuff. How long this window of weakness? How deep? And is this a process you see as being a gradual one, or are we in like crash risk?
So right now, to be very clear, this is the beginning of a window of weakness and a correction. I do not see this as a current 20% decline. Okay. We've been very clear. We highlighted this many months ago that starting in around February options expiration, we would get 10 to 12% decline. Right? Still think that's the case. It's very orchestrated, controlled. Entities were prepared for it. Again, we talked about all the people. The communication's been clear. The administration's been pretty clear. Here it comes. But just as clear will be a response with QE, right? On the other side, monetary-driven policy.
You think that's what, Q3? When does that happen?
No, that happens sooner.
Yeah?
That happens sooner.
Okay.
I believe that happens probably in the next 3 months.
Do you still think this year we get 6% 10-year, or are these things going to actually work to some effect to bring that down?
Well, last year, if you remember, we called for 5, and we got it about 2-3 weeks late.
Yeah.
Right?
Still got real close, though.
Yeah. What I think actually is this decline, as we go into recession, so for 3-4 months, will in the 10-year will continue, and inflation will come down. Okay. But as QE hits, call it in 3 months or 2 months or whenever it is, right? I think there's going to be a knee jerk. The front end of the curve will come down. The back end will kind of soften. That'll be a buy the yield, sell the news, whatever you want to call it, event. Okay. That'll eventually take that 10-year higher. So I do think we're going to push back towards 6. It's still my view.
Very. It's the second half.
However unpopular that was earlier, now it's even more unpopular. The best time on these secular trades, and we've been doing in this trade.
You think that's second half of the year,
basically? I think it's second half, yes.
Right, okay.
Yes, exactly.
All right, Cem Karsan.
All right, so jam-packed full of information over there. I absolutely love it. So he's making the same call here that if you watch the full video, he talks about the populist demand is for more equality. People don't like this. The haves have more, the have-nots have less, and there's this call for this populism, which, if given, would be inflationary. Because putting money in the hands of the consumer, however you do it, is inflationary. There's no real way around that. So he's saying that the administration, although they're saying that, what they're going to do is to cause this a recession so that they can bring down the 10-year yield, bring down inflation, so win the inflation fight, and then do QE, which inadvertently he says will then cause a bunch of inflation. So there's all kinds of trades there. right? So this window of weakness, I mean, I've been short since the 21st of February.
You've been short crypto.
Crypto, well, I've been doing prop firm trading as well. So
Right. Okay.
yeah. And then also, so after this Windows weakness is done, we've seen from the beautiful indicator that that you created last time. Let me just pull that up on the screen. Your liquidity indicator. We have here the possibility that if you see at the bottom right, that yellow line is that liquidity offset.
Offset
And so
by 70, right?
78 days, yeah.
78, right.
So then over here, we have liquidity already starting to be pumped into the market. That'll show up then, right? So even though the liquidity is going up concurrently now, we're getting a downdraft in the market. It takes some time for that to bleed through. And then some months from now, April, May, June, we should start seeing QE really start to ramp up. So that's bullish for risk assets, bad for Main Street, good for Wall Street, and the trades sort of write themselves.
Mm-hmm. I think that's in line with the expectation that we should still see a pause in Fed rates by May. So it is even June, most likely June, where we start to see rate cuts from your to your point.
Right. Well, I'm wondering if this downdraft that we're getting within the market, it's like we're only at the beginning of the window of weakness. So this could keep going until in COVID it went all the way down to March 13th, I think. The market just kept going down. So we'll see. Obviously, we're not not locking down the whole world, but let's see what happens. We never know what catalyst might happen. But then if we get recessionary data, we get a slowing growth or what have you, then that pause I think will change real quick. They're going to start asking for cuts, and they'll have the cover to do that. So that's what I'm really excited for. Well, I don't know what to say excited for. I don't like what's happening in the world, but I do like that there's a way to profit from it if it's going to happen anyway. That's the way I feel.
Now, what do you think the yields market is telling us? Even short-term and longer-term treasury yields are all pulling back at the moment.
That's what I thought was fascinating because it's pulling back. I can't believe it's pulling back on inflationary concerns. I think it's pulling back on growth concerns, right? The falling yields, especially long-term yields, is saying that the bond market, the trillion-dollar, multi-trillion-dollar bond market, is saying, hey, we think growth is going to be lower in the future than it is right now. So much so that it'll counteract whatever inflationary effects that we've been having over the last 5 years. And so that's a warning sign. That's a sign of, hey, yeah, QE can come. And this is what Ken was just saying, that the major players are positioned for this, for the yields to come down temporarily, inflation to ease, and then when they come in for QE, then after that we see on the back half of the year, beginning of next year, yields at 6%, which would make sense. So we'll see. But that means in that interim, we could get crazy crypto up. We can get all-time highs, and so for me, the trade is long crypto, and as Kem has said before, long calls. If now you're buying calls 3 months out, 3 months, 6 months out, they're going to be cheaper because the market's down, and you can get some nice returns on those calls, even on single stocks. If you're interested in single stocks, you still can do calls on those single stocks and not have to expose yourself to holding the actual asset.
Fascinating. Yeah, that's worth taking a look at.
All right. Let's move on to this next one. So Luke Gromen, who's a part of the FinTwit community, he's a analyst, is sounding the alarm. Central banks are hoarding gold at a suspicious pace, while Bitcoin outflows suggest a shift in sentiment. Could gold double or even quadruple just to restore historical valuations? I didn't ask you. You didn't get a chance to watch Luke Gromen on Tucker Carlson, right?
No.
So whenever I see legitimate, known FinTwit people in the mainstream, I breathe a sigh of relief, because usually the most that you get to see there are just a bunch of charlatans, people who don't know what they're talking about, or Peter Schiff.
Always my favorite.
Exactly. He'll go anywhere. I totally understand why. But you don't get the mentality of, hey, like, this is how the the monetary system works. Like, this is technically how it works. This is not right or left. This is what is happening. And watching Gromen talk to Carson's head was like blown about some of the things that he was saying that you and I just take for granted. Yeah, that's how the financial system works. Like, how did you think it worked? And so I thought it was very interesting. There are a couple of clips I want to play from that, but the most important thing here for me is that, and this is what I want you to pay attention to, is that they keep circling around Triffin's dilemma. They're like, why is this happening this way, and how come this is this way, and what's going on, and they don't actually say, hey, this is the effect of Triffin's dilemma, which if you remember, we talked about it some months ago. People were very interested in that idea of what does being the world reserve currency actually mean? What does it look like? What are the downsides from it?
Mm-hmm.
So I'll just play a couple of clips here, and then I'll ask a couple of questions. Second.
There's puts and takes.
So here's going to make the case for this is central banks are accumulating gold because they believe there's going to be a fundamental shift to the financial system, or a potential of a fundamental shift, and that you need gold in order to back that transition.
So you're describing a world that's so complex and interconnected, where global finance, the cost of energy, and then, the geostrategic stuff, the, military rivalries, it's all of a piece. So it's like pretty scary to mess with any single factor in that in a dramatic way. That's kind of
it's disruptive. It's potentially disruptive.
Super disruptive.
Yeah, it's potentially, and I think that's ultimately the power and the encouraging thing about gold. Gold is always thought about as you're buying gold, you're a doomer, the world's going to end. No. Part of the problem of what I just described, change in and of itself isn't a problem, but rapid change when you have high levels of debt, it's the debt that creates the problem. And so when you look around and you see these central banks buying all this gold and having all these countries buying this gold, if you revalue gold enough to basically recollateralize or effectively buy down your debt so that you have low debt levels, then you can make more dramatic changes to the economic system and its connections.
So for people who don't know that, the gold that the U.S. government has is valued at $42 or something and change per ounce. But gold's trading at thousands of dollars per ounce. And so they could revalue gold, have more collateral on the balance sheet, and then use that excess to then pay down debt. Which is this weird backhand way of printing money without printing money. And if everyone does this, then everyone can dramatically pay down debt while they transition to a new system, and it would mitigate that transition over. So he's saying that they're stockpiling gold. Central banks are stockpiling gold in anticipation for something like this happening, which is not crazy, right? 80 years ago or whatever it was, we had the last time it happened when the dollar became the reserve currency, and they had to do the same sort of thing over there. So let's just jump straight to, I thought it was interesting. This is actually at the end of the video. They're wondering, why is it happening? Why is this happening?
Right.
That's why, when you've got this dichotomy where for 40 years, from 1974 to 2014, global central banks were buying treasury bonds, and they were selling gold.
Why would you ever buy a bond from the same person who can print the currency? I just don't understand that. I mean,
if you believe the inflation numbers, and look, there are.
But I mean, it's kind of like a rigged system, right? Like the government is issuing the debt, which is held in a specific currency, but that same government prints that currency.
Yeah, and that's why they're so hyper focused on the Fed managing inflation. I know it
doesn't make any sense.
Okay, so people have this mentality all the time. I don't know if you've seen this, Mike. They go, "Why would anyone buy U.S. Treasuries if the U.S. government can print money? Why would they be doing that?" And what I find fascinating is that just half an hour before in this video, they actually explain why. Here's the second part. This is half an hour earlier, where they actually touched on the answer.
Compared with what happened in COVID, which was, hey, we need more PPE and supplies and what have you. And China said, just as soon as we get, ours, we were dependent on China in COVID. And it was made crystal clear to Washington that the defense industrial base has been too hollowed out by this currency system whereby we export dollars and we export our factories and our workers, and China sends us stuff and we send them dollars, and they send us goods they send us goods, we send them dollars, and then they reinvest those dollars in our financial markets. And that's fine. That has been how the world has worked for 50 years. And it's been great for Wall Street. It's been great for Washington. It's been great for China. It's not been great for the American middle and working class whose factories got offshore to China. And Washington was fine with that until all of a sudden they realized this process has gone so far, we cannot credibly fight a war without Chinese factories. And the Defense Department is saying, and they began saying it 10 years ago, no mas, we're done here. We need to start reshoring as a matter of national security. And the origin problem is the structure of this dollar system. And so
then he goes on to explain more about the dollar Dutch disease in the sense that the United States prints the world reserve currency. It's their main export. And so then the economy deteriorates until everything is geared towards getting more dollars out the door. And so why do other countries sell goods to the United States? To get the dollars. They need the dollars in order to generate global commerce. And why would they buy treasuries when you can print the money? Because they need those dollars for the commerce. While United States has the ticking time bomb of eventually eroding their manufacturing base and their social base until they can no longer sustain themselves. So it's actually to the benefit of everybody else to let the empire print dollars until they get to their own collapse. It's like, and they're like, okay, well, we just get to sit here and watch while you guys just print until you got nothing left. And so this is why I find it to be this is sort of like a train wreck where you can see if the goal is to print as many dollars as possible, anything that gets in the way of that, anything that gets in the way of dollars exiting is not likely to succeed. So that's why, to me, the dollar trade of long dollars over time, like try to get as many US dollars as you can over time, makes sense because the dollar will crash up as people need more and more dollars and it's less dollars available. The dollar will just increase in value. It's not going to crash to zero now. It's going to crash to 300 on the DXY. That to me is what's so fascinating. So I thought this was very interesting. The video is interesting. It ends with him making a gold prediction that if you do believe that gold will be the thing that is used to transition out of the US dollar system, great. If you think it's Bitcoin, then Bitcoin is the thing you want to buy. And if you think there's no solution, then you think there's no solution. But just two people who care about the subject are banging their head together and they're not hitting on the point of, oh, it's supposed to be this way. That's how the system works.
I don't think that the Treasury should continue to value gold at a statutory price of $42 an ounce. That definitely seems to be worth updating. It's a little unclear to me the impact that has at a macro level. If we were to actually update the statutory price, what are your thoughts on that?
Well, it's like the first reason why they depegged gold from the dollar was to be able to inflate the currency without being restrained by the gold reserves, right? So you didn't actually have to back every dollar with a dollar's worth of gold. They could print ad nauseum. But because gold has not been used as has not been the medium of exchange, there is no need to update the valuation. So when the central banks are buying gold, they're just marking it at a certain price and they just leave it there. There's no reason for them to float it. They're not trading it in any way.
That makes sense. Okay.
But they could actually do that with anything. Like they could revalue anything. Any country could revalue and say this is what the value for the price controls for whatever it is they want to do. And so this is sort of like the reason to do it on gold is that we already have some idea that gold is worth something. Like no one really knows why gold's the thing that but we know that's the case, and it's already trading at 3,000. Right?
Yeah, I get that part. But if they were to revalue it, and by the way, from what I'm reading here, the Treasury is dismissing the idea of revaluing it. We've kept it pegged since the 1970s and nothing's ever changed, right?
Yeah.
If we were to revalue it, though, a lot of experts are under the impression that this could cause gold prices to surge even higher, like to your point earlier.
Skyrocket.
Right.
Absolutely.
So interesting. Now, of course, one of the other theories that could lead to this is that both Trump and Elon are actually talking about wanting to visit Fort Knox just to personally check if Fort Knox actually has the gold we claim we do. Now, I'm no conspiracy theorist. I'm sure the gold is there. I'm sure it'll be interesting if they find it. It'll be interesting to see how the conversation shifts if we were to decide to head in that direction. I mean, are you under the impression that there's an advantage this current administration would gain by forcing the Treasury or pushing or influencing the Treasury to try to revalue gold?
I think the danger is like what Gromen was saying. The uncertainty of what that would do would cause volatility. Even if the underlying idea eventually might be good, we would have years, 10, 20 years worth of massive volatility as people not understanding how they're supposed to value anything.
Right.
The volatility, when it's extreme, you need volatility to make money. But if it's extreme, like if you woke up tomorrow and gold was at $1 million, you'd be like, okay, my life has just significantly changed. Like I have to make very different decisions.
Yeah.
But if it's at 5,000, okay, you can live with that.
Yeah, true.
So if they go to Fort Knox, and this is why I don't understand the Fort Knox thing. If there is no gold there, definitely don't tell anybody. What are you talking about? What benefit could that do? And if it is there, then there's nothing to look. Just leave it.
That's right. So however you feel on the subject, I don't think we're ever going to know for sure, even if Trump comes back and says, yeah, there's gold in there.
That's right. I just love the idea of the Twitter stream walkthrough of the gold.
That would be hilarious if he does like a live stream to go through.
Yeah. All right. I did wanted to mention one other thing for that, which is the gold inflows and Bitcoin outflows. I don't know if you you sent this to me. We're having this so if you just looked at the stats last year, it was the exact opposite. All the inflows were going into Bitcoin and the outflows of or diminished inflows into gold, and that has switched. And so this is what I was talking about when we talked about Fort Knox initially. The rumblings about Fort Knox and gold and all that, like I don't care about that in every other cycle, but we are in a major change cycle right now where things like this could be significant. When you're seeing these inflows into gold is an indicator that people and institutions have a great lack of faith within the economic system. That's what that means. And what I find fascinating is that, do you remember for a while Bitcoin was moving in correlation with gold in this way? And people were like saying, "Oh, Bitcoin's a safe haven asset."
Yeah, right. Store of value.
Exactly. And then now that's like not the case.
Not the case.
Exact opposite.
Well, it's pegged to equities now. There's a higher correlation for crypto and equities now than ever before.
It's doing worse than equities.
Right.
Well, and so you're like,
sure, in terms of overall price difference or percentage change difference, but the actual correlation in movement is roughly the same. Yeah.
Right. It's like a high beta to the market. And so like I'm not sure what to make of it because the flows of that Cem Karsan was talking about, the options flows, from what I understood, it's not supposed to really affect Bitcoin as much because, well, that's not true. There are quite a bit of options now inside of the Bitcoin space. So I'm just not sure when the quarterly expirations happen there. But the drop that we saw in Bitcoin happened exactly where your liquidity indicator was talking about a drop in liquidity. So it makes sense. And so I'm still inclined to believe that it is still it's like the store of value that's highly volatile. And I think when we get the rebound, or if we get the rebound, we bounce off 74,000, which is one of the levels you talked about last time. We bounce off 74,000. If we get to 250,000, Bitcoin, the conversation of this dip will be like nothing. It'll be like the dips we had.
And that's what makes this still look very bullish. Of course, just observing the charts. The 74,000 pullback point is on target. We're only 10,000 away at this point, and that's not too much further down. That's another 12% move from here. So yeah, I'm fully expecting we pull back a little bit further just to test that support level at 75,000, and then see where we start to continue from there. But that will sort of confirm this range between 74 and the last all-time high.
That's right. Okay, so you're still seeing that your low, because mine is there too. My low is at 74,000.
Yep.
So you see Bitcoin get to that level and you're a buyer.
Yes.
right.
With confirmation. Always with confirmation.
You and the confirmation. Buy the fallen knife. I want to get the bottom of that wick, Mike. Confirmation.
With an uptrend like this, if you're trading momentum, which most people are in crypto, you're going to need confirmation to the upside first. If you are trading mean reversion, sure, I'll buy the falling knife. In this case, this is a trend following strategy. So
okay, so I could say logical, reasonable things too, Mike. Doesn't mean anything.
Stop.
All right. So last up here, actually, before we jump into our final segment, let's take a moment to shout out Traders Post. Traders Post is an automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, Traders Post connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to traderspost.io and see how easy it is to streamline your trading. Traders Post, because your strategy deserves to run at full speed. I should also add in there that you have a trial. There's no reason not to try it out. Go sign up for the trial.
7 days, give it a roll, see how things go. Yeah,
exactly. All right. So for the last story here, Nvidia beat earnings expectations, but it wasn't the blowout some people had hoped for. CEO Jensen Huang confirmed that demand for AI compute power is still soaring, but is the stock already priced for perfection? This I found was pretty funny. This is why I find it difficult to trade like single stocks, because you have basically Nvidia, their fourth quarter earnings report, they beat for revenue. They had a 78% increase from the same quarter last year, but people were expecting way more. They beat for
they beat on earnings, but only by a small amount. Both earnings and revenue were only beat. They only beat by about 3% on revenue and 4% on earnings,
right,
or 5% on earnings. So really not quite the blowout that we were hoping for. It just shows that Wall Street analysts actually did a pretty good job of projecting where they thought Nvidia was going to show up.
What I find interesting is you can make billions, and still your stock can be like, forget it. I thought you were going to make it.
I mean, this is the thing that's always fascinating to me with Nvidia in general. Showing that they reported $39 billion in revenue is just incredible to me. And earnings per share, of course, are still pretty impressive. So go ahead.
Still, we got the I always love when the CEO of a company comes out and acts casual on like CNBC or some news station, because I know the stock price is moving them. They're not here for nothing. They're not here just for giggles. And so Huang was on CNBC the other day, and I thought it was interesting what he was saying, that he's going to make the pitch here that we actually do need way more compute than you think. Because that was like the whole idea here, that with DeepSeek that came out, that hey, maybe we don't need as much compute for the training chips, we just need the inference chips, and maybe some of these stocks, these AI stocks, are overvalued. So let's just hear what he has to say over here.
That's on top of what we already knew to have POs and forecasts and such. The midterm comes from the fact that this year's capital investment for data centers is so much greater than last year's. And of course, we had a very large year last year. We had a great year last year. It stands to reason that with Blackwell and with all the new data centers going online, we're going to have a fairly great year. Now, long term, the thing that's really exciting is we're just at the beginning of the reasoning AI era. This is the time when AI is thinking to itself before it answers a question. Instead of just immediately generating an answer, it'll reason about it, maybe break it down step by step. It'll do maybe some searching in its own mind before it creates and composes a smart answer for you. The amount of computation necessary to do that reasoning process is 100 times more than what we used to do. So if you could imagine, we thought computation, the amount of compute necessary, was a lot last year. And then all of a sudden, reasoning AI, DeepSeek was an example of that. ChatGPT 4o is an example of that. Grok 3 reasoning is an example of that. So all of these reasoning AI models now need a lot more compute than what we used to used to
Well,
were
let me
expecting.
stop you
And so
there,
that puts
because
even more load.
Because some people took DeepSeek to mean actually that you need less compute, right? Because the initial report was that they were doing more with less. But you're saying, in fact, some of what came out of DeepSeek was the opposite, that there's going to be more compute demanded. Unpack that for me.
There are three phases in how AI works, how AI is developed largely. Number one is pre-training. It's kind of like us going through high school. A lot of basic math, basic language, basic everything. That basic understanding of human knowledge is essential to do what's the next step, which is called post-training. In post-training, you might get human feedback. You know, it's like a teacher showing it to you. We call it reinforcement learning, human feedback. You might practice and do thought experiments. You're just preparing for a test. You're doing a whole lot of practices. We call it reinforcement learning, AI feedback. You could even either also do tests and practice, and we call it reinforcement learning, verifiable reward feedback. So now basically it's AIs teaching AIs how to be better AIs. That post-training process is where an enormous amount of innovation is happening right now. A lot of it happened with these reasoning models. And that computation load could be 100 times more than pre-training. And then here comes inference, the reasoning process. Instead of just spewing out an answer, when prompted, it reasons about it. It thinks about how best to answer that question, breaks it down step by step, might even reflect upon it, come up with several versions, pick the best one, and then presents it to you. So the amount of computation that we have to do, even at inference time now, is 100 times more than what we used to do when ChatGPT first came out.
So this is pretty important to cover. And I know that we've discussed in the past the relevance of Jevons paradox here as well, because I think he's describing two pretty important facets of our AI experience as we work with these tools. And that is much more of this engaging interactive process of getting the model to reason through the things that you're talking about. And as you observe the model reasoning through things step by step, there's no reason that you don't necessarily catch back up with it and say, okay, I see how you've broken that down, but I need you to consider this too, right? And you're giving it more feedback to help it reason even further and take the thought process even further, effectively helping AI overthink, if you will, or deeply analyze something. So as the problem spaces increase and we use these tools more frequently and more people start to engage with them, and the cost becomes more affordable to us as like hardware and these models are commoditized, I think it's fair to say that NVIDIA will continue to see increased surging demand for hardware as more and more companies jump on to try to create these environments to use these tools. There's no question about it.
Yeah, it's like that the unit of intelligence, I guess, if you wanted to break it down like that, that I was thinking before, that a lot of people were thinking was this, like, you know, standard unit that we're all just guessing at. Turns out there's refinement that can be done to it so that it actually gets purer and purer and purer and purer and purer. And so you go, wait, well then if it's only limited, then we're back to, hey, if this is only limited by the amount of compute and energy that we have, then increasing compute and energy, which is the case he's making. He's like, no.
Well, the case he's also making is that it's not just about pre-training anymore. That's been the large headline news, is around what it took to actually build the model at OpenAI versus what it took to build the model at DeepSeek. Huang is making the argument that's a part of the equation, sure, but now you have to couple that with the compute requirements for just reasoning through problems or thinking through additional steps and working through additional prompts. And I'm saying couple that with increased demand for the products themselves as more and more companies start to adopt AI, and the compute requirements continue to go up.
That's right. It's like when in metallurgy, if you go from iron to steel, and then you're like, okay, the steel is way more durable, lasts way longer, doesn't rust the same way, all that. And you're like, okay, we're going to need less of this. And turns out, no, it actually need way more steel. And then you find out if you break the steel and then weld it together, that welded steel is stronger than the steel it was originally. So then you have this more process that's happening. And so we're finding this with the I don't know how much you're using the deep research for Grok or for ChatGPT or whatever.
A little bit, yeah.
And when I'm seeing it processing the information in the back,
Mhm.
and it's doing all these questioning that I would have done, and then now I get to the end and it's way more robust,
Mhm.
I go, oh, we're at the beginning.
Right.
Like this is going to be incredible. This
Except
is gonna
for
be
except for
fantastic.
when it's wrong about its reasonings for the pullbacks there. You know, what it didn't highlight in your Grok research is the effect that the options market had on our pullback here.
The only reason it did that is because Grok doesn't have access to all the YouTube videos and all the. Once it does, my
That's the
Notebook
problem.
LM, it had that information. So I'll grab the Grok information,
Yeah,
paste it into Notebook LM that has all of Cem Carson's videos, and then it'll be like, hey, this is what Cem would have said accordingly, and then I just go back and forth.
Fascinating.
But I don't want to be that. I want the AI to do that. Okay, let's just get it
put all
together.
the resources together. Yeah, it should have a
Exactly.
constant feed of everything happening on all these platforms, right?
That's right. So if we take a look at just want to take a look at the stock here for Nvidia real quick before we leave, and the so what is it, a 20% pullback from the high,
Mhm.
if I'm not mistaken. Yeah, about a 20% pullback. And would you say that, like, it would seem to me that this drop that we had since February, well, the drop started before the drop in the market, right? So the drop in the market started like around February 21st, if I'm not mistaken, and Nvidia started beforehand. But the long-term buy for this, I'm trying to convince myself that every dip here should be purchased because the case hasn't been invalidated for AI. In fact, I'm more convinced of it now than ever before.
Mhm.
So I'm wondering here, like, at what levels would you actually want to buy this? If I was going to go based on my signals, man, I'm never going to get $82 on this.
I think, interestingly, today's close is pretty fascinating to me. So there is a trend line forming at the more recent low of April 19th of 2024 and August 5th of 2024, and these last two lows. That trend line would help me feel pretty confident that we may have closed at a decent pullback here. There are some short-term moving averages you could probably consider from here and see if support continues. But I would probably start dollar cost averaging in from here, but also expect that the price could pull back even further to around $99 or $100 a share before starting to add a little bit more.
I see. Okay. So I'm going to wait till after the window of weakness that
given
Master Cem
the
Karsan?
context that we still expect the market could pull back another 7 or 8%, then yeah, Nvidia is going to be a huge participant in that. So I would not put everything all in on Nvidia just yet.
Excellent. No, just all in on Bitcoin. Catch the. All right. So that's it for the stories for this week. It's been jam-packed. I've been very much enjoying it. Have to cut it down. We didn't get to talk about Baba that went up 78% over since the beginning of the year.
We didn't get to talk about HIMS pulling back another 45 or 50% from the last time we covered the story.
Well, I wanted to wait on that because I think HIMS will jump back up to to double topish to the sell-in region, and then there I want to do a story of them predicting that the price will fall.
Okay,
so it'll be there.
I'll put my prediction out right now. I think now is a pretty good entry zone for HIMS. This is a really nice pullback into a support zone. So if we're looking ahead to the next episode, I'm already interested right about this point.
Excellent. Perfect. All right. So we'll leave it there. We'll be back next Friday with more after hours. But until then, happy trading, folks.
Cheers, everyone.